Setoff and carry forward of losses. So in set-off and carry forward of losses, we are having 5 heads of income. Okay, salary. You can get the salary, the one head. You can get the salary from 2 employers also. Employer 1, employer 2, like. Second one being income from house property, where you may have multiple house properties also. We assume that we have 2 house properties and we generate income from 2 house properties. Third being PGBP. In case of PGBP, we have classifications like section 35 AD business, specified business, where we have 2 specified businesses. Speculation business, there also we have 2 businesses. General, not falling under the above 2 category, we have 2 businesses. Like we have 3 sets of businesses here. 3 sets of business. Section 35 AD, specified and speculation and general. Fourth being capital gains. Under capital gains also we have 2 predominant categories like long-term capital gain 1 and 2 and short-term capital gain 1 and 2. We have 2 short-term capital gains and 2 long-term capital gains, like, okay, 2 or 3, more than 2 or 3. And fifth one is all about income from other sources. Under income from other sources, we may have 3 categories here. One is casual income, betting, gambling and lottery, like, right, winning from betting, gambling. Casual income. We have 2 casual incomes, and owning and maintaining race horses. Also we have 2 businesses. Others like interest or dividend or letting out of the machinery and all, like, you understand. So these are called heads of income. Heads of income, 5 heads of incomes are there, and this will be called as a source of income within salary. Source of income within income from house properties. So within the head we may have multiple sources. Is that okay? Now see, in salary we don't have losses. We always have the profit. We don't have the losses. In case of house property, we may have profit or losses. Is that okay? Let's see. In salary, we have only profit component. There is no loss. That's why most of the people are interested to go for the employment. No risk at all. Doing the business will be always risky, so don't want to go there. What about the income from house property? We may have profit or loss. And in case of section 35 AD, specified business, we have two specified businesses. Assume one business gives you profit, another business gives you loss. Okay. Similarly, speculation, in one business we gain, another business we lose. General, in one business we gain, another business we lose. Similarly, in case of capital gain, we have two major sources. Within that, we have still two subdivisions also. One long-term capital gain and one long-term capital loss we have. Similarly, short-term capital gain and short-term capital loss we earn. Winning from betting, gambling, even lottery. Okay, sometimes we have the profit, sometimes we have loss. So as it is betting, gambling, most of the cases loss only. And owning and maintaining race horses. See, if you are betting in the race, right, horse race, that will be the casual income. But you are owning the horse races to be used for the betting and gambling purpose. You are letting out your horses for the gambling purpose. Then it is called owning and maintenance of the race horses. It's not gambling. It is not gambling. Okay, it's a business. It is business. So I have 10 horses, and similarly few others also owning and maintaining the horses, around 100 horses, are now used for betting and gambling purpose, and participants will bet on some horses to win the prize money. But being myself owner of the horses, if I allow my horses to participate in the gambling, I may get a fees for that. Okay, so whether the horse wins or not, as I'm allowing, I'm getting the fees. Then that will be my revenue, and owning and maintenance of the horses will have expenses. From the revenue, if you subtract, there will be either profit or loss. Okay, if I am participating in the betting, then winning will come under casual income, losing also part of casual income. So here we have the profit and loss. Others may be letting out of the plots and machinery, and also we have seen all the other things in the income from other sources. Sometimes we may gain, sometimes we may lose. Is that clear? Now, whenever there's a loss in a head, that loss will be adjusted in the other sources of the same head. That's the main thing you have to understand. For example, in case from loss from income from house property can be adjusted gain in the income from house property. Okay. So as I already told you, salary we don't have the losses. Salary we don't have the losses. Salary we don't have the losses. Is that clear? Salary we don't have the losses, but others we may have the losses. So from this it is very clear, if there is a loss in a source and if there is any gain in the same head in some other source, you can set off usually. This is a general provision. General provision. Loss from house property 2 can be adjusted in the gain from the house property number 1. Okay, this is called intra-head adjustment under section 70. Under section 70. And in case of specified business, the loss in specified business can be adjusted in the loss in profit in specified business. Speculation business also, the loss will be adjusted in the speculation. And in general, if there is a loss, can be adjusted in the profit in the other business. Long-term capital loss can be adjusted in the long-term capital gain, and short-term capital loss can be adjusted in the short-term capital gain. Casual income loss cannot be adjusted, and profit will be automatically fully taxable. Fully taxable. Taxable. This is very, very important thing. Loss cannot be adjustable. That should be forgotten. In case of loss from betting and gambling, will not be adjustable in any other income if you have. You have to pay the tax for the income, and loss is it's personal. They will not allow you to adjust the loss in the other income. Clear? Hope you will be now able to understand this one. This is always will not be considered. But in case of profit, always taxable. Sir, if there is any gain, can I adjust that gain? If there is any loss in some other head, can I adjust the loss in this casual income profit, sir? No, that cannot be done. That cannot be done. Similarly, winning from race horses. Okay, owning and maintenance of the race horses. One case loss, another case gain can be adjusted here. And this way, this one can also be adjusted here. Clear? And the other thing is, this general business ultimate being loss can be adjusted in either specified business or speculation business. Specified business or speculation business. But vice versa not possible. Vice versa not possible. If specified business loss can be adjusted only in the specified business gain, speculation business loss also be adjusted only in the speculation business. The other way you cannot adjust this. This can be carried forward if there is an ultimate gain. So if there is ultimate loss, that loss can be adjusted in the profit of specified and speculation. But if there is any loss in these two heads, that can be carried forward for the future to be adjusted, cannot be adjusted in other heads. Cannot be adjusted in other heads. Hope you will be now able to understand. In case if I lose short-term capital gain, then that can be adjusted in the long term, but vice versa not possible. So here in two short-term capital gains, one 100 rupees gain, another one is 150 loss capital gain. Clear? So the loss can be adjusted in the profit of the long term, but in long term 100 rupees 150 loss, and if there is a loss 50, can I adjust that in the short term? No, it's not possible. Short term can be adjusted in the long term, but long term cannot be adjusted in the short term. Clear? So speculation, government never entertains the speculation business, so the government will not be allowing you to adjust the loss in any other income. What about the specified business? Sir, in case of specified business, government gives huge deductions. 100% of capital expenditure can be debited in the P&L of under section 3580 we have seen. As lots of benefits are there, most of the cases there will be loss only. As safely you accumulate those losses to be adjusted the other business means government is not interested. You can carry forward to be adjusted later on, not in other business. These two, what are they? Specified and speculation. Similarly, in case of capital gains, short-term capital loss can be adjusted in the long term, but vice versa, not possible. Clear? Hope now you'll be able to understand. This is what about the adjustment of losses of any source in the other source of the same head. Other source of the same head. Okay, understand that. This is head number 1. Head number 1, head number 2, head number 3, 5 heads of income, right? Within the head we have multiple income means multiple sources. Multiple sources. Clear? Hope now you'll be able to understand. So, if there is any loss in a source, that can be adjusted in the other source in the same head. But exceptions are there. The exceptions are now highlighted here. And you know that we don't have loss here. We have always profit in case of salary. Section 70 is over. This is called intra-head adjustments. As per that one, loss in respect of any source of income shall be set off against income from the other source under the same head. 5 heads are there. Within the 5 heads, we have multiple sources. If there is a loss in one of the sources, can be adjusted in the other source of the same head. Income from house property, where we have 3 houses, 2 houses are giving me loss, and you can adjust that in the profit of the other house. Can be done. Of course, there are exceptions. What are they? Speculation, specified, and long term, and owning and maintenance of the resources. These 3 I have just explained. Speculation loss can be adjusted only in speculation gain. Specific business loss can be adjusted only in the gain of the specific business. Okay. Provided this section 3580 is available only if the assessee apps out the default tax regime. Okay. If you apps the default tax regime, section 3580 benefit is not there, so automatically second point will not be applicable. And owning and maintaining racehorses can also be adjusted in the gain of the owning and maintenance of the racehorses. Long-term capital loss can be adjusted only in the long term, not in the short term. Rest of the things you can adjust within the same source. So what are the main thing? Short-term capital loss can be adjusted either in long term or short term, doesn't matter. In case of winning from lotteries, crossword puzzles and all, cannot be adjusted the loss in any way. No set off, no carry forward in case of loss. In case of gain, the entire gain is taxable. Entire gain is taxable. In case if the income is exempt, what happens in case of loss from the exempted source? Also not considered. As income not considered means income includes loss, that should also be not considered. Is that okay? Agricultural business, right, is totally exempted. If there is a loss, can we set up this in some other business? As the income from agricultural business is exempted, the profit or loss, whatever it may be, completely exempted. Is that clear? Hope now you'll be able to understand the section 70. Clear? Now, let's move on to the next one. Let's move on to the next one. What is that? After all these things, if there is loss in one head, now loss in source adjusted in the other source of the same head. Now we are going to calculate the profit or loss from every head. If there is any profit from first head or second head or third head, okay, no problem. In the case of loss, what can we do? Is that clear? Those already disqualified cannot be adjusted. What are the things already disqualified? This cannot be adjusted. Section 35 AD cannot be adjustable. And speculation cannot be adjustable. Long term cannot be adjustable. And race horses cannot be adjustable. Casual cannot be adjustable. Except these four. Okay. Specified, speculation, long term, casual, and race horses. These things are already disqualified to be adjusted in the other source of the same head as per section 70. Some other sources of income can be adjusted in the other sources of the same head. After adjusting, if there is a loss, probably you see the loss in PGBP. So here is a loss. This loss is adjusted here, here. After that, we have the losses. So what happens, sir? There is a loss in here, here that cannot be adjusted. It can be carried forward for the future to be adjusted later on, not now. Clear? Now, we'll move on to the section 72. As per the section, sorry, 71. As per section 71, if any head faces the loss, that can be adjusted in some other heads. Head to head. Earlier, source to source within the same head. Now, head to head. Okay. Leaving the things what we have already disqualified. What are the things we are already disqualified? Specified, speculation, long term, and casual income, as well as owning and maintenance of the race horses. These five are already disqualified. If there is a loss, can be carried forward only. Next year's gain, in that you can adjust this. But after this adjustment, if there is a loss, in the head there is a loss. Ultimately, PGBP head shows a loss, capital gains shows a loss, income from other sources faces a loss, and house property we face loss. What can we do? Can we adjust the loss in any of the head with the other head's gain? That's what about we are going to study under section 71. Yes, of course you can do. Provided this income from house property loss can be adjustable in any source. Either it may be adjusted in the salary, even can be adjusted any other income like PGBP, capital gains, other sources. Wherever you want to adjust, you can adjust. Okay, but maximum 2 lakhs. Maximum 2 lakhs. You can adjust this loss maximum 2 lakhs only, not beyond that. That too, if you are shifting out of 115 BAC. 115 BAC. Okay, under default tax regime, you are not eligible for adjusting this 2 lakhs also. Right. Now, what about this one, sir? This one can be adjusted in any, okay, in any head except salary. Except salary. You know that already these two are disqualified. From this, it is very clear the loss from the general PGBP can be adjusted in the income from house property gain or capital gains or income from other sources. Clear? That's very, very important. Now, what about this one, sir? These two are disqualified. What are the cash flow and ratios? This can be also adjusted. This can be adjusted in any head. Can be adjusted in any head. What are they? Leaving the casual and race horses. Whatever the other loss we face, okay, can be adjusted in any heads, including salary. Including salary, no problem here. This is what about the section 71. So we have completed two main sections. This is called interhead. 70 is all about intra-head or inter-source. Intra-head means within the head. Okay, one source to the other source. Inter-head means one head to other head. The loss under one head is set off against income under the other head in the same previous year. Loss source. Loss from house property can be adjusted in any other head up to 2 lakhs only. There is a limit. Non-specified, non-speculation business, the general business showed a loss, can be adjusted any gain except salary. Then income from other sources. In that income from other sources, winning and owning and maintenance of resources are disqualified. Other than that, can be adjusted in any sources. Note. Okay. Other than the loss listed above, including capital loss, cannot be set off in other head. We have already studied. Capital gains cannot be adjusted. Okay. It cannot be adjusted. Is that okay? And then what more? Nothing can be set off in winning from lotteries and crossword puzzles. If there is any casual income, that will be completely taxable. If you have any income or loss in any other head, can I adjust that loss in this? No, not possible. So winning from betting, gambling, maybe 1 lakh. PGVP, you have 50,000 loss. Can I adjust this here? No, sir. This loss cannot be adjusted in the casual income. Cannot be adjusted in the casual income. Is that okay? And set off is mandatory. You have to set off. We have the options to set off your loss in some other head. You cannot escape. You have to set off this year itself. You cannot carry forward in the next year. Sir, I don't want to set up this year, sir. Can I carry forward and set up the next year? No. If you have the options to set up in this year, you have to do set off itself, today itself. Income from house property is allowed to be set off against income under other head. Available only if the assessee opts out of the default tax regime. Okay. So under default tax regime, this income from house property loss cannot be set off at all. Clear? Now let's see. This one for our understanding. Order of adjustment in salary. So in salary, what can we adjust? In salary, what can we adjust? Either income from house property or this income from other sources. Only these two can be adjusted in the salary. Between these two, which can be adjusted? First choice goes to income from other sources, because once income from other sources, after the set off, if we face loss, cannot be carried forward. But in case of income from house property, if there is a loss, can be carried forward and adjusted in the next year. Okay. If you lose this, you can adjust the next year. But in case of income from house property, if you lose, you cannot carry forward and adjust the future. Okay, you have to pay the tax for the gain and loss. You cannot do. You no need to pay the tax, but you cannot adjust this in any other income to reduce your tax liability. That's the logic here. So then the order of priority. Loss from other sources, as it is not allowed to carry forward, should be adjusted first. Then you can go for the adjusting the loss of house property. But anyhow, winning from race horses, betting, gambling, lottery, crossword puzzles, as well as loss from owning and maintenance of race horses, these two cannot be adjusted in the salary. So in income from house property, we have 3 blocks. Only one can be adjusted in any income. Okay, rest of the 2 cannot be adjusted. So first priority goes for adjusting the loss of income from other sources in any other heads. After that, if we still have any gain in the other heads, okay, then income from house property loss can be adjusted. So these are the 2 things. Come on, try to understand, try to solve this illustration. Business loss is eligible or not eligible for set off against income from salaries. From the salaries only we can adjust two things. One is income from house property, another one is income from other sources other than two items. Okay, so not eligible is the correct answer. Not eligible is the correct answer. Come on, now try to solve this illustration. Amit furnishes the following particulars of income pertaining to the previous year 24-25. Profit from trading business, loss from manufacturing business, loss from profession, profit from speculation. So these are general business. These two are speculation. Okay, so these two are loss. So these two losses can be adjusted here. Ultimately, we get 2 lakhs. And 2.5 gain 3 is the loss. You can adjust this here. But negative 0.5, what we can do? Okay, can I adjust this here? Speculation cannot be adjusted in the general, but general loss can be adjusted. So this is not possible. Otherwise is possible. So this is going to be taxable in this current year itself. This can be carried forward to be adjusted in the loss of the next year, the gain of the next year. If in the next year, if you gain, this loss can be adjusted in the next year's gain. Clear? Hope now you will be able to understand this one. He has no other income during the year. Determine the total income of Amit for the assessment year 25-26. Also state the loss to be carried forward. So we completed. This loss is carried forward. This is going to be taxable in this current year. Shall I move on to the next one? Yes. From the following information, compute the total income of Mr. Ramesh for the assessment year 25-26. Income from salary, house property, business, and short term and long term. Short term capital gain, long term capital gain, everything is okay. But there is a business loss, which is non speculative. In case of non speculative business loss, can be adjusted where? All the incomes except salary. So this 320 can be adjusted income from house property, or you can adjust that in the short term capital gain also to the extent of 140. Out of 320, 1 lakh and 140 can be adjusted. Set off. And still how much we have? 80 can be adjusted here. So taxable value, salary remains as it is, completely taxable. Income from house property we already adjusted, so nothing is taxable. Business loss we adjusted already. Short term capital gain dash and long term capital gain 2 lakhs. Now what is the taxable income? 4 lakh 60. You may ask this way, sir, this 320, 1 lakh is adjusted 220. Can we adjust the 220 here, sir? Okay. Can we adjust this way? 1 lakh here, 2.2 lakhs here. In this case, 2.6 income from salary and house property 1 lakh, business loss dash, short term capital gain 1.4 lakhs, long term capital gain being 0.6 lakhs. Can we do this way? Here also 4.6 lakhs. Here also 4.6 lakhs. Can we do so? Actually, long term capital gain carries a flat rate of 20%. But short term will be taxable at the usual rate. If he falls under the higher tax bracket, he has to pay the tax at the rate of 30%. So he has to now show the taxable profit which is going to be taxed at the lower rate. Okay, if you feel long term capital gain being taxable at the higher rate, okay, if your income is 0 or you are falling under 5% or 10% slab, then you can adjust this in short term. Or if you are falling under 30%, then the loss can be adjusted in the short term. That's a choice. You can do both the way to decide which will be the most suitable for the assessee. So the ultimate aim is to reduce the tax liability. Okay, clear? Hope now you'll be able to understand. Now let's move on to the next illustration, a comprehensive illustration to make you understand the entire logic what we have discussed up to now, section 70 and 71. So intra-head and inter-head adjustments over. Now compute the gross total income of Mr. SSA. 5 heads and different sources are given here. Salary from A and salary from B, where he works to company A full time and B in part time, probably in weekends like. So both will be taxable. So 340 plus 120 overall taxable income in this case being 4,60,000. This is taxable. Income from house property, this loss can be adjusted here. And PGBP, this loss can be adjusted here. After this, we still have 3 lakhs loss here. Here we have 1 lakh gain. Speculation, this loss can be adjusted in the speculation business gain. So ultimately we have 1 lakh gain. And specified business, this loss can be adjusted here. After adjusting, still we have 1 lakh net gain in specified. Agriculture business is exempted, so will not consider this part at all. Okay, specified. So these are exempted business, so we'll never bother about showing this in our account. And short-term capital gain and loss. Here there is a loss, here gain, so that ultimate 2 lakhs loss is there. And in long term there's a gain and another one we face loss, so ultimate being 1 lakh gain. Owning and maintaining race horses. This loss can be adjusted here. After adjusting 2 lakhs, we still have the loss. Okay. Income from race horses, betting, gambling and all. Loss will not be adjustable. This gain is always taxable. Gain is always taxable. I'll take to the last column because it is always taxable. Clear. Interest and dividend. Here is a loss and here is a gain. You can adjust this. So ultimately we have 2 lakhs rupees loss. It is not being the interest and dividend, maybe some other letting out because interest and dividend we don't face loss. Even though if there is any borrowings for investing and further if you are paying the interest, then the amount deductible only 20%. So there will not be definitely loss. Anyhow, any other income. Okay. So ultimately in salary we gain how much? 4.6 lakhs. Now that general business loss can be adjusted where? Speculation and specified business. In that you can adjust this. So this 3 lakhs is adjusted in these two. Ultimately we have 1 lakh. And short term can be adjusted in the long term. But vice versa not possible. So this 2 lakhs can be adjusted in this 1 lakh. So 1 lakh we still have loss here. And owning and maintenance of the race horses, you don't have the options to adjust this loss in any other head. So it should be carried forward to be adjusted in the subsequent years gain because of owning and maintaining the race horses, not in this year. And this 2 lakhs can be adjusted in any head. Hope now you'll be able to understand. We have completed within the same source over. Within the same head is over. Intra head or inter source over. 1 lakh loss. Okay, this is 1 lakh loss. Okay, thank you. Clear? This 1 lakh being loss. So finish up every head separately. Especially PGBP and capital gains and income from other sources within the same head, we have 3 different categories: specified, speculation, as well as general. In case of PGBP, of course, exemption you can remove it. In capital gains, we have 2 different heads, 2 different categories like short term and long term. In income from other sources, we have 3 categories like owning and maintenance of the race horses and betting and gambling like casual income. Last one is other than that. In case of betting and gambling, loss is always forgotten, but in case of gain, it should be always taxable. No other loss can be adjusted here, not allowed to be adjusted. It's a punishable, like you have to pay the tax, a flat rate of 30% on this income. Right. Now, So what we have done, we have completed intra-head. Section 70 is over. Now we may move on to the section 71, interhead. First, you start with what? This one, because income from other sources can be adjusted in any income in this year. If you leave, you cannot adjust the subsequent period. So first choice goes to this one. Second choice goes to PGBP income. In case of capital gain, it cannot be adjusted. So this will be carried forward. In case of loss in short term, capital gain can be adjusted in the long term. After the adjustment, if there is a loss, this can be carried forward only. This cannot be set off in any other head. One head to the other head adjustment is possible only for the income from house property, PGBP, income from other sources, the last category. Other than the winning and maintenance, casual income and owning and maintenance of the resources. So only these three can be carried forward to be adjusted in the other head. Can be adjusted in the other head. So this cannot be adjusted. This 1 lakh can be carried forward. Already this 2 lakhs carried forward. Now this 1 lakh is carried forward. This 2 lakhs can be adjusted where? In salary, we have 4.6 lakhs here. So in this 4.6 lakhs, this 2 lakhs can be adjustable. Point number 1. Thereafter, if we have the general profit and loss, that general profit and loss can be adjusted in the income from house property. Income from house property, we have 1 lakh rupees gain. This 1 lakh can be adjusted where? Only here. This 2 lakh can be adjusted where? Any head. So even you can adjust that in the income from salary. Here also you can adjust. So the ultimately taxable income being, this is cancelled and 4.6 and minus 2, 2.6 is taxable amount here. So gross taxable income in this year being 4,60,000 and the amount to be carried forward being this one. This can be carried forward and this can be carried forward. These two income can be carried forward for the future period to be adjusted. Hope now you'll be able to understand the set off and carry forward. What happens if the loss is not adjusted in this year? We carry forward for the future period to be adjusted. Within how many years we can adjust? That's the last part. Once that is over, the entire chapter is over. Only 2 more provisions. With that, set off carry forward chapter is over. Clear? If it is clear, text me. Online students, make it faster. Once again. The last one is, if the loss cannot be adjusted in any other heads, okay, in this current year, what can we do? Can we have the options to adjust in the next year's profit? Yes, that will be coming under carry forward and set off. This is set off directly. Okay, set off of one source loss in the other source income. We studied under section 70. One head's loss in the other head's gain in section 71. Now we don't have the other options to adjust the loss. Can we carry forward and adjust that in the subsequent year's profit? Yes, of course we can do. If it is so, how many years can be carried forward? So in case of income from house property, it can be carried forward and adjusted over 8 years period. Most of the cases 8 years only. Okay. Of course, salary we don't have losses. In case of PGBP, non-speculation can be carried forward and adjusted in 4 years. General can be 8 years, and in case of specified business and limited, any number of years. Long-term and short-term can be adjusted for 8 future years profit, no problem here. And owning and maintenance of the resources only 4 years, only 4 years. So all other things cannot be adjustable. Yeah, of course, already told you know, in case of loss from other sources, especially owning and maintenance of the resources only can be adjustable for 4 years. Similar to that, speculation also. These two are not motivated by the government. So any of giving a warning like only 4 years allowed to be adjusted. If there is a loss in the assessment year 25-26 can be adjusted in 26-27, 27-28, 28-29, 29-30. Within that year, you have to adjust what? Speculation and owning and maintenance of the resources. Rest of the other things are and 8 years, especially 35 AD, government motivates to start business, right? So because of that reason, they can adjust that for any number of future years, any number of future years. Is that clear? Hope now we'll be able to understand. Once it is not adjustable in any other heads in the current year, carry forward and adjust in the same head, same head. So here, if there is a loss in income from house property, can be adjusted in the salary or any other heads, right? In case of PGBP, can be adjusted in any other any other head except salary, and in case of income from other sources, can be adjusted in any heads. But once if it is not adjustable, carried forward, what can we do, sir? If it is carried forward, can be adjustable only in the same head. Okay, if there is a loss in income from house property, carried forward after, can be adjusted only in the gain of house property. PGBP loss can be adjustable only in the PGBP gain. Capital gain loss can be adjustable only in the capital gain in future period. That too, short term will be adjustable in short term and long term, but long term can be adjustable only long term. And owning and maintenance of resources can be adjustable only from the profit of the owning and maintenance. The same head. Okay, this will be under section 71B. This will be under 72. Speculation business 73. Specified business 73A. Of course, not required to be memorized. Capital gains are under section 74, and this will be 74A. With that, all the items are over now. Okay. Now remember, in case what? In case business loss. Business loss can be categorized into two losses. One is loss due to the depreciation. Another one is the loss due to the other than depreciation. Loss due to the depreciation, loss due to the other than depreciation. In case loss due to the depreciation, what can we do, sir? The loss due to the depreciation can be adjusted in any head for any number of future years. Understand? If there is a loss due to the depreciation, can I adjust this in salary? Of course, you can adjust. Can I adjust that in the income from house property? Can be adjusted. PGBP can be adjusted. Sir, carry it forward, sir. Can I adjust that in any other head? Of course. Because adjustments of the unabsorbed depreciation not dealt under this chapter. Dealt under section 32 itself. Already told you. Okay. So, depreciation, unamortized depreciation can be carried forward and adjustable in any head for any number of years. Not dealt under this one. So, this particular one will not include what? Depreciation. This will not include depreciation other than depreciation. Now, in case of depreciation, see in your P&L account, your GP being 1000, here your depreciation being 500, and your other expenses, operating expenses being 1500. Okay, 1600. What about the net loss here? 1100 is the net loss. Now the net loss is grouped into or segregated into due to the depreciation, other than depreciation. Due to the depreciation being 500, for other than depreciation being the balance is called PGBP loss, 600. This one can be carried forward for the future, adjustable within 8 years, that too in PGBP gain only. This one can be carried forward for any number of future years, adjustable in any income. Understand? Because this is dealt under section 32, not here. Section 32, class 2, not here. Clear? You can recap that along with the PGBP chapter we discussed already. Now, shall I move to the next one? So, all the content what I have explained is available within this page, not more than that. only one page. Within this page, everything is included. Carry forward and set off. Okay, income from house property, everything is completed. Business loss. In case of business loss, carried forward and set off only by the same assessee, except in case of succession by inheritances. I have a business loss of rupees 1 lakh, I closed my business. After that, some third party purchases all of my assets and continues the business. Will he be able to enjoy the carried forward loss to be adjusted in his own subsequent year's profit? No. But if it is succession by inheritances, after my life, if my successors are taking over that, then they can enjoy the benefit. Okay. The order of set off. What are they? Here we have 3 blocks. See here. Already we studied in case of scientific R&D expenses, family planning promotion expenses. These expenses cannot be debited, then it will be treated like depreciation. That's how we studied already under section 35, under section 35, class 1, 36. 36, class 1, subclass 9. Are you able to recollect this? So this will be section 32, scientific R&D and family planning promotion expenses. All the 3 will be treated same way, but these 2 are very rare, scientific R&D and these 2. But if it is available, you can treat that as same manner. Is that okay? Now, if you have all these items, how can we adjust this, sir? One is first current year business loss, current year PGBP loss, okay, our business loss can be adjusted first, and current year depreciation will be adjusted. Depreciation along with scientific R&D and family planning promotion expenses. Okay, so when I say the term depreciation, it always includes scientific R&D, unabsorbed expenses and family planning promotion expenses. This is the first source. After that, you can now adjust the brought forward business loss, then brought forward unabsorbed depreciation, and automatically it includes scientific R&D as well as family planning promotion expenses. Set 1, set 2. That's the order you can adjust in the subsequent period. So current year business loss first, second being current year depreciation, third being current year capital expenditure on scientific research and current year expenditure on family planning. You can link these 2, no issue. So then these 3 is now grouped into 2 items. Like thereafter, brought forward business loss as per section 72, brought forward unabsorbed depreciation as per section 32, class 2, already we referred, and section 35 scientific R&D, section 36 class 1, subclass 9 is for the family planning expenses. These 3. That's the order of adjustment. If there is income under any head, eligible losses under any other head, such a loss shall be first set off against the income before set off and carry forward of losses. Okay. So first you have to adjust the losses of any other head. If you are possible to adjust in some other heads, then you have to do that first. Only then you can set off and carry forward of the subsequent losses. Okay. First you have to finish up this one, then you can carry on with the next. Carry forward and set off is not allowed. When? See, how many losses you can carry forward and set off? Income from house property, PGBP. In that we have Section 35 AD, specified business, speculation business, general business, and capital gains as well as owning and maintenance of race horses. These are the 4 types of losses can be carried forward for the future to be adjusted, right? Now, here in this PGBP again we have 2 categories. What are they? Depreciation and others. Now, leaving these 2, what is that? Income from house property and depreciation. All other losses can be adjustable only in the future. Okay, provided if the ROI is filed promptly within the due date is applicable for this. You have to file the return of income within the due date for filing purpose. Only then you are eligible for claiming the deductions are set off carry forward in the subsequent period. But in case of loss in income from house property, depreciation filing is not mandatory. For all other things, to claim the deductions in the next year, you have to show that you faced loss in the previous year. That too before the due date for filing of the return of income. So we have the separate chapter to be discussed later on, ROI. Is that okay? So, carry forward and set off is allowed only if the ROI is filed within the due date. Exceptions for the depreciation income from house property, these 2, of course, ROI filing is not required. ROI filing is not required. Clear? Now, we'll move on to the next one. Mr. Anurag, an individual engaged in the business having turnover of 1.5 crores and no international transaction or specified domestic transaction incurred loss from the business during the previous year 24-25. So 1.5 crores. Maybe he is in need of auditing. If he is in need of auditing, 31st October will be the due date for filing of return of income. Okay. Now, such business loss could not be set off against any other income during the year. He filed the return of loss for the assessment year 25-26 on 31st March 2026. So the cutoff date is this one. This is the due date for filing of the return of income, but he missed to file within the due date for return of filing of the return of income. Can Mr. Anurag carry forward such loss for set off against the income from the business of the assessment year? So, can he adjust the business loss? No, because ROI filing is not as per the required due date. Is there any difference if Mr. Anurag has unabsorbed depreciation instead of loss from the business in the previous year for carry forward to assessment year 25-26 for set off? In case of unabsorbed depreciation, ROI is not required, so you can simply carry forward and adjust that loss in any year. You can adjust that in any year. Hope you will be now able to understand this one. That's all. Chapter is over. All the content over. So before we finish off, we'll try to solve few illustrations. So I have given around 3-4 illustrations here. Okay. 1, 2 illustrations. 3 illustrations are there. I try to finish up all the 3 illustrations. So with that, this chapter is over. After that, we'll straight away move on to the next chapter, deductions. Probably in this class, we'll start with the deductions. At least 1 or 2 deductions we try to finish up in this class. By the next class, probably in Saturday, I will finish up deduction chapter. Sunday, I may finish off almost all the content except TDS. TDS and TCs. Okay. Let's now start. If it is clear, text me. Let's see. During the year ended 31st March 25, Mr. Subramani has following income for the brought forward losses and the brought forward losses. So, short-term capital gain on sale of shares, long-term capital loss for the assessment year 23-24 and short-term. These 2 are brought forward losses. Okay, brought forward losses. And cost of lottery tickets purchased. This is expenses or loss for the cash flow income will not be considered at all. Loss from betting, also casual income will not be taken. Income from card games, of course, these two are casual income, will be totally taxable. The loss in any other head cannot be adjustable here. So that will be totally taxable. So we have only two nature income and expenses. One is being the capital gain, another one is being casual income. Okay. So now let's start with the capital gains. Under that, we have been given short-term capital gain. How much is that? 2,60,000. And we have long-term capital gain 78,000. And then long-term capital loss of the prior period losses can be adjusted only the long-term, you know. So now first you enjoy this because it has a restriction. Long-term can be adjusted only in the long-term. Short-term can be adjusted in the short-term as well as long-term both. So this 90 can be adjusted here only 78. Balance long-term capital gain, especially loss. How much is that? 12,000 related to the assessment year 23-24. Okay, can be carried forward. 23-24. That's the year in which happened. If you are not able to adjust that, you carry forward and adjust in the subsequent 8 years. So 24, 25, 25, 26, like you go on for the 8 years to be adjusted. So still you have the chance to adjust this in future. In case of short-term capital loss, 80,000 rupees, you have sufficient short-term capital loss gain here, so I can adjust this. 1,80,000 is taxable value. Here, this will be 0. And capital gain taxable in this case being 1,80,000. 1,80,000. Then in income from other sources, especially casual income, expenses or loss cannot be adjustable, but the gain will be totally taxable. Sir, there is around 12,000 loss, can we adjust it? No chance at all. No loss can be adjusted in the gain due to the casual income. Okay. So here what happens? Long-term capital gain, income from lotteries, completely taxable. This value being 3,10,000. And income from card games, the value being 80. The gross taxable income in this case being, come on, 5,70,000 rupees. This loss cannot be adjustable here in any other income, so it should be carried forward. Can be adjustable in the subsequent long-term capital gain if we have. Okay. Clear? Text me. Now, let's move on to the next illustration. A comprehensive illustration here. Following are the particulars of Mr. S. Fifth point is all about the following losses have been carried forward from the prior years. Long-term capital loss we have related to the assessment year 22-23. So we have 8 years to be adjusted, so no problem. Loss from silver speculation. This is a speculation business loss. Speculation business loss can be adjusted only in the speculation business gain, and which was discontinued in the assessment year 23-24. Doesn't matter. We try to adjust these two losses here. This can be adjusted only in the long-term capital gain. This can be adjusted only in the speculation gain. So here income from house property we have two properties R and J. J has a loss and R has a gain. So this can be adjusted here. After that, we have 8,000 rupees loss. This is called intra-head adjustment. Intra-head adjustments. Before you go for one head to the other head, finish up the intra-head first of all. Similarly, non-speculation, this 50 can be adjusted here. Still we have 10,000 rupees loss. And speculation, this can be adjusted here. Still we have 30,000 rupees speculation gain. Speculation gain. Capital gain, short term can be adjusted in the long term. After this, we have 20,000 rupees gain in the long term. Card game loss cannot be adjusted from activity of owning and maintenance of the racehorses. Here's two places for maintaining the racehorses. One is Mumbai and Kolkata. In Mumbai, there's a loss, and Kolkata, there's a gain. This loss can be adjusted here. After that, ultimate being loss only. Dividend from Indian companies and income from letting out the plant and machinery. These two are taxable. These two are taxable. 1,21,000. Now, this long-term capital loss can be adjusted here. Carried forward losses is adjusted here, related to the year 22-23. This 25,000 can be adjusted here. Speculation loss brought forward from the previous year can be adjusted in the speculation gain in the current year, related to the assessment year 22-23. Now, after that, we have 8,000 rupees property loss. We have 10,000 rupees business loss. We have 5,000 rupees in speculation business gain. We have 2,000 in the capital gain. This 10,000 can be carried forward only. How many years you can carry forward? 4 years you can carry forward. Owning and maintenance of the racehorses, due to that, if you face any loss, that loss cannot be adjusted in any other head, can be carried forward. This 1,21,000 will be either allowed to adjust the losses of any other head. Now, so we have completed intra head. Now we will go for inter head. Section 70 is over. Now section 71. As per section 71, this one and this one can be adjusted in all the heads. That's all. Income from house property can be adjusted in speculation business as well as capital gain, and the income from other sources related to this one. Now all the heads it can be adjustable. Similarly, this 10,000 can also be adjustable, as it is being the general business loss, can be adjusted in any head except salary. So no need to now do some other adjustments. Directly sum this. 5,000 plus 2,000 plus 1,21,000. From there you can subtract the 18,000 directly, because this 18,000 is deductible under all other heads income we have now. What is the final value? 1,10,000. This will be no other options. You can carry forward. This can be carried forward. Clear? Let's now move on to the last illustration. Mr. Day furnishes the following particulars of income for the previous year 24-25. Previous year income. These are the previous year income. Carried forward unabsorbed losses for the losses and depreciation. Unit C, business was discontinued. That doesn't matter. Business loss and depreciation we have. Okay. And unit D also business. Okay. So, what are the things will be adjusted in case of business? Current year, business loss if any, then current year depreciation if any, then brought forward business loss, then brought forward depreciation. This is the order of adjustment. 1, 2, 3, 4. This is the order of adjustment. Current year business loss 4 lakhs, unabsorbed depreciation 2 lakhs. One business has a profit. So what we can do, you can adjust these things here. 4 lakhs and 2 lakhs, 6 lakhs can be adjustable here. But we have sufficient gain here. 10 plus 2, 12 lakhs we have. We have 12 lakhs, we can adjust this. And brought forward business loss 3 plus 3, 6 lakhs can also be adjustable. Can also be adjustable. Okay. 3 lakhs, 3 lakhs. This is related to business C. This one is related to business D. Okay. Now, after adjusting the 6 lakhs, we still have 4 lakhs. This 4 lakhs can be used for adjusting the current year business loss also. Actually, 4 lakhs first, thereafter these two. Okay, but anyhow, I have the options to adjust in the income from house property also, so I am waiting for this. And unabsorbed depreciation can be adjusted here. Okay, so from this it is very clear. 6 lakhs can be adjustable. We have 12 lakhs to be adjusted. Okay, can be adjusted completely as per this provisions. While brought forward, business loss will be the first priority. 3 plus 3, 6 lakhs. These 3 plus 3, 6 lakhs also be adjusted here. So naturally your income will be 0. Unabsorbed depreciation in this case being 2 lakhs and 1 lakh. 3 lakhs can be carried forward for infinite period. This 3 lakhs can be carried forward to infinite period. Clear? Deductions from gross total income. A list of deductions given under chapter 6A. Under chapter 6A. All these things are starting with section 60 onwards. Section 60 C onwards. Okay. Now, some basic ideas you have to keep in your mind. Any of deductions will be very least important in the coming days. Most of the assessees now opting for the new tax regime. Under new tax regime, we can enjoy only 3 deductions. Only these 3 deductions. So here I have given almost 2 pages like for the various deductions. But if you opt the default tax regime, you will be eligible for only these 3. These 3 will not be suitable for or available for most of the assessees. Most of the assessees. Okay. So the deduction chapter itself seems to be outdated in a matter of 1 year later. Okay. So as far as my concern in your examination, this chapter will be least important. Okay. As we shift to the new tax regime, most of the deductions are skipped. Okay. Anyhow, still you have to study this for this batch. We'll go in detail of these things, right? Now let's start with first deductions directly. Rest of the some theory related to the deductions can be covered later on. So 80A to 80B are the related theory. I will cover that later on. So I'll start with 80C. So we have deductions starting from 80C and ending with 80U. You can now group this 80C to CCH. All these things nothing but the contributions, like you can keep in your mind. C represents contributions for your future requirement. So during my employment, I generate the money, but at the time of retirement, I need to have financial support. What can I do? During the employment itself, you save some money for your future requirement. Like you can buy an LIC policy, or you can invest in some mutual funds or some pension fund, or you can buy a house property and all. For all of your future savings, if you are investing, those things can be claimable as deduction from your salary under this set 80C series. And for the health reason, ADD, doctor. D for doctor, health reason. For education, E series and interest. Okay. So education loan and interest for some other borrowing. Okay. The spelling for interest being interest, right? So to make it easily understandable, ATE, ATEEA, and all these things. And G series all about donations. G series for donation. Give to somebody else. Don't keep everything with you. Earn and give something to somebody else. Donate. Okay. G all comes under donation. And JJ, make the world JJ by recruiting additional employees. For that, you can claim the deductions JJAA. RRB, QQB are the patent, right? RRB, Railway Recruitment Board patent. Like you can keep that idea in your mind. QQB and RRB. And TTA, TTB are the deductions available for the interest from savings bank account as well as any other interest from any other deposits. ATU, unable. I am being physically challenged or I am not able to work like others. Physically challenged, unable. Can I enjoy some other additional benefits? Then yes, of course, you can enjoy some other benefits coming under ATC. Hope now you'll be able to understand all the sections easily with this group. C represents future contribution. Contribute for your future requirement. D related to the doctor. E related to some interest. And G related to the donations. And J, QQB, RRB for the patent right. And TTA is interest and U is for unable persons. Among these set, most time consuming being ATC. ATC is the most time consuming. So we'll try to finish up that ATC now. Okay. ATC. Deductions with respect to some specified investments. This ATC is applicable for individuals. Hindu undivided family should be maybe applicable for resident and non-resident. So both can enjoy this benefit. Okay. Deductions with respect to the specified investments. Sorry. Clear. And the maximum deductions being 1,50,000 and amount invested in this will be the income chargeable to tax or not. Okay. Clear. See, you have PGBP income as well as agri income. PGBP income 1 lakh, agri income being 2 lakhs. If I invest from this 2 lakhs, can I claim the deduction? As you know that agri income is the exempted one, PGBP is the taxable income. To claim the deductions for the investments you made for your future requirement, that should be either it may be taxable income or exempted income, doesn't matter. The deductions is allowed. The deduction is allowed. Is that okay? 3 points. ATC deduction is available for investment you make. Okay, for your future requirement. Either you by an individual or half may be available, maybe resident, non-resident. But the maximum deduction is 1.5 lakhs only. Right. The amount you invested for this may be out of your taxable income or exempted income. That doesn't matter. You can claim the deductions. Now, we have been given a set here. These are the investments you can make. Clear? Now, a complete list is given, but if you go and read your institute material, especially CA, it runs through more than 40-50 pages. This alone. Okay, here I have given an essence of the deductions only. You try to understand these things first of all. Okay, units, units LRPM. Okay. Here 4N, 2T, 3S, 3P. Okay. Units LRPM. Now, U represents units of mutual fund. Units of mutual funds. If you are investing in units of mutual fund, you can claim the deductions. Mutual fund or ULIP and all, you can claim the deductions with LIC, whatever it may be. And N, we have 4 investments starting with N. Okay. One is being NSC, National Savings Certificate. Another one is NABARD Bank bonds and any other investment in NABARD. Okay. Another one being National Housing Bank investment. Another one is National Pension Scheme. So 4N. U represents units and N represents the NSE bonds, NABARD investment, National Housing Bank, National Pension Scheme. This National Pension Scheme falls under Tier 2. Tier 2. Okay. Not falling under 80CCD. Not being 80CCD. National Pension Scheme. And I represents infrastructure bonds. Okay. Infrastructure bonds. Okay, if you are investing in any company involving infrastructure development, in that company's bond, if you are purchasing, you can claim the deductions under this one. Either it may be bonds, or shares, or debentures. You can buy. And we have 3 years. 3 years. Okay. So we have 2T and 3 years. T. T is nothing but the tuition fee. Tuition fee paid for the children. That too from a recognized institutions, and the payment should be within India. Or term deposit. Term deposit. Okay. Minimum period of withdrawal being 5 years. Lock-in period should be 5 years and above. So units. U represents units of mutual fund or ULIP schemes. 4 kinds of N. National Savings Certificate, NABARD, investments in NABARD, National Housing Bank, and National Pension Scheme. Tier 2, and infrastructure bonds, shares, or debentures. Or if you are purchasing the shares and debentures of infrastructure companies, you will be eligible for claiming the deductions. And tuition fees, term deposits can also be tuition fees for children's tuition fees, that too payable within India. And we have 3 years here. We have 3 years. Okay. One is all about Suganya Samriddhi account. Another one is senior citizen scheme. Senior citizen scheme, saving schemes, and stamp duty paid for purchasing the house property. You may pay the stamp duty, right? That can be claimable as deduction. And Suganya Samriddhi account for the girl child's investment for the girl child's name. Suganya Samruddhi. Okay. Samruddhi account. Okay. 3 years. L represents life insurance, LIC. R represents repayment of loan borrowed for housing purpose. Repayment of loan, housing loan. Okay. We have 3P. 3P. PF and all. Okay, one is all about PPF and recognized provident fund, etc. Another one being pension fund. Okay, annuity plan. Okay, pension like annuity. Another one being superannuation fund. Superannuation also be part of a pension fund like, so I included that in the P. Superannuation. These are the 3P. Finally, M, mutual fund. Mutual fund or investment in UTA. So I have given the complete list here. Units, LRPM. So if you are investing in these schemes, you will be eligible for claiming the deductions. The maximum being 1,50,000. 1,50,000 can be deductible. Let's see all the things in detail. U. ULIP of UTA or LIC. You have to invest continuously for a minimum period of 5 years. If you are getting a ULIP, okay, yearly fee maybe or premium maybe 10,000 rupees. You pay 10,000 rupees year on year at least for 5 years. Only then you will be eligible for claiming the deductions. Applicable for individual if the ULIP scheme is on the assessee's name or spouse and children eligible for claiming the deductions. In case of HUF, any member's name it can be invested, you can claim the deductions. Okay. If you are cancelling that within 5 years, the deductions earlier enjoyed is reversed. Now you have to pay the tax. Is that okay? That's all about you. Contribution of ULIP. Self, spouse and children. Self, spouse and children. Not on parents. Not on parents. NSC, National Savings Certificates and interest accrued thereon, both will be considered as deductions under section 80C. Okay. And NSC can be in joint names also. And individual means they can get the NIC either in the he himself or spouse or minor child name. Minor child name you can purchase. Okay. N. Another N being bonds from NABARD. NABARD. Okay. And another N being National Housing Bank, where you can deposit any schemes, contribution to pension fund or any whatever the nature may be, you can invest. And another N being NPS, additional account, other than 80CCD named as Tier 2. Tier 1 comes under 80CCD, we will be studying that in the next. Okay. So 80CCD will fall under 80C deductions. Other than 80CCD, NPS will fall under 80C. And Tier 1 NPS falls under 80CCD. We will study that later on. Hope now you will be able to understand all the 4 items. ULIP of UTA or LIC, National Savings Certificate and interest accrued thereon, NABARD bonds, and National Housing Bank and NPS Tier 2. Now, I represents infrastructure companies. In that company, shares or debentures if you purchase, you can claim the deductions. T represents tuition fees, another being term time deposits. The amount deposited should be locked in for 5 years. The deposit could be in post office or scheduled bank. If you are withdrawing that within 5 years, then deductions allowed already will be reversed. You have to pay the tax. And in case of tuition fee, okay, your parents are paying the tuition fees for you, they can claim the deductions under section 80C if they apt the old tax regime. In the new tax regime, of course, nothing is there. Only 3 things are allowable. Rest will be not qualified for deductions under new tax regime. Is that okay? Now, tuition fees. Except donation fee should not be in the name of donation. It should be fees for the education. And should be for full-time education, payable only for the 2 children of such individuals. Payable to university, college or education institution situated in India only then can be claimable. Some of the students of Singar Academy asked me to give the certificate for fee payment to claim the deduction under section 80C. I always tell them so it's not allowable. So it's only for university, college and education institution. Any of they claimed using the certificate I give, okay, as a evidence to payment for the tuition fees. Okay, any other education institution, we can assume this may also be an education institution, like, but it's not actually applicable. It's a private. It should not be. So tuition fees for the full-time education, maximum 2 children, payable to university, college and education institutions can be deductible. Okay, and triple S, number 1 being Senior Citizen Savings Scheme. Another one is stamp duty paid on acquisition of house rent. It's a house property. If you are purchasing the house property, you have to get it registered. Now, further you are paying the stamp duty. That stamp duty payment can claimed as deductions, right? Usually it is around 9 to 11%. It depends upon the state, right? In India, Tamil Nadu, no, it comes around 9%. Okay, so if you are purchasing a property for 50 lakhs, 9% being 4.5 lakhs, you have to pay the stamp duty alone. That 4.5 lakhs can be deductible, but the maximum 1.5 lakhs can be deductible here. And Suganya Samriddhi account, okay, SSA, Suganya Samriddhi account is an account for investing for the girl child or herself. Okay, even being a legal guardian can invest. Okay, And withdrawal with interest from this scheme is also exempted later on. Suganya Samriddhi account. So triple S is there. One is senior citizen savings scheme, another one is stamp duty paid, third one is Suganya Samriddhi account. All the three will be considered as deduction under section 80C. Now, life insurance premium paid. Already I touched this point along with the capital gains, income from other sources chapter as well as capital gains. In capital gains chapter, capital assets. In capital assets, no, any life insurance premium paid beyond 2.5 lakhs per annum as premium, that will be qualified as a capital assets, of course, taxable. In the premium is less than 2.5 lakhs, not taxable. That's how we studied there and also studied under income from other sources also. So now you have to understand that LIC concepts in detail here, right? Now, you have to understand sum assured as well as premium. Usually, sum assured being 1 lakh means the premium. Usually, the life insurance policy may vary the term between 5 years to 20 years also. Sometimes it may be 25 years also. So, usually 20 years is the regular stream we have. So, immediately see if you are getting the employment, probably by 20 or 25 you get settled, then automatically your relatives and friends will thrust you to purchase the LIC policies, right? So, immediately LIC policy will be the right choice to start investing in your life. So if you are investing, they will tell you wait for 20 years. Now 20 or 25, from there 20 years you have to wait for getting the lump sum amount. So you go for 20 years. So that sum assured 1 lakh is divided by 20 years. Every year you have to pay only 5,000 rupees as a premium. Only 5,000 as a premium. Sometimes no, 1 lakh can be invested within 10 years. Then every year you have to invest 10,000 rupees. Even lump sum investment is made. I don't want to invest the premium year after year, sir. I don't get the premium year after year, so I'll finish up investing completely today. So that may also be possible. That may also be possible. So various schemes are there. So if the sum assured being 1 lakh, for the 20 years you divide that 1 lakh by 20 years, every year you have to pay 5,000 rupees. So by investing or paying the premium 5,000 rupees every year, by the end of 20th year, you might have paid 1 lakh rupees and you can withdraw the entire 1 lakh. What's the gain in that, sir? So you'll be getting additional bonus or any other profit because of this one. So that will be called bonus or reversionary bonus or cash bonus by whatever may be added at the time of you receive it. Clear? So anything happens, worst case, demised, then by the end of 5th year or 6th year, something happened bad, then you will get entire 1 lakh. The sum assured will get. Okay, if you are surviving for all the term, then you will get the full value plus some extra bonus. Halfway through died means definitely 1 lakh. So for 5 years, you may pay 5,000 rupees per year. For 5 years, 25,000 you might have paid. But anything happen, your family will get 1 lakh rupees at least. If there is any small bonus available, that will also be payable. Clear? That's a scheme. Now, you have to understand the logic between the terms. You have to understand the terms of sum assured and premium. Sum assured is otherwise called policy value. 3 years are there. 31/3/2012 beforehand and after this date. After this date. Is that okay? 2 dates are there. Here, deduction is restricted to 20% of sum assured. And thereafter it is reduced to 10% only. Okay. Thereafter it is reduced to 10%. Sum assured being or policy value being 1 lakh. Right. If you pay 25,000, what happens? During this period, 25,000 or 20% is only 20,000 is deductible. If the policy taken after 1/4 on or after 1/4/2012, only 10% of the sum assured, 10,000 is deductible, balance is disqualified. Balance is disqualified. Is that clear? In case of physically challenged, the same 20%, 10%, but 10% up to 1 more year. Okay. 31/3/2013. Thereafter, this limit is increased from 10 to 15%. This is for physically challenged. Clear? So in general, what happens, if the policy taken on or before 31/3/2012, 20% of sum assured can be deductible. After that date, only 10% is allowed. In case of physically challenged, 31st March 2012, before that, on that date or before that date, if the policy is taken, 20% will be taken. After that date, 1 year, to the extent of 1 year, only 10% is allowed. After that, from 2013 onwards, 15% of sum assured is allowable for the physically challenged. Is that clear? And for individual case, self, spouse and children is allowable, provided the children should be either dependent or independent, doesn't matter, you can enjoy the deductions. But not on parents. Is that okay? For half any member, it will be applicable. Deductions reversible if insurance is cancelled due to non-payment of dividend or premium. And the claim, if you receive later on, deductible with respect to 80DD. Okay. So I can insure for myself, my spouse, or my son or daughter, right? My children, whether being dependent or not dependent. If my son or daughter being physically challenged, can I invest? Of course I can invest. Can I claim the deduction to section 80C? Of course I can claim the deduction to section 80C, or I can claim the deduction to section 80DD also. I have been given the options. If I am insuring or I am taking the insurance premium for a dependent disabled person, if I get the claim for that, then it is always taxable. Otherwise, it is completely exempted. I take the policy, I am getting the maturity value, completely exempted, no problem here. But the policy is taken on the dependent disabled. After that, if you are getting the maturity amount, that is taxable. Claim received for the insurance made for the dependent disabled as per section 80DD provisions. And any Keyman insurance policy for that any claim received also be taxable. But the associate died after that, relatives, legal heirs are getting, now it is not going to be taxable. Is that clear? Hope you will be now able to understand. LIC surveys because of this one provision 80C. LIC surveys. Now this exemption is also be removed due to the new tax regime. All the LIC agents will promote this particular point. Sir, today you can claim the deductions. Later on, if you are withdrawing, nothing is taxable. Then slowly they have curtailed. On or after 1/4/2013, 1/4/2012, the limit is reduced from 20 to 10. Okay. Now the one more condition, 2.5 lakhs condition is also that we have studied under income from other sources, the limit, that's all. In income from other sources, this point I have not taught you. You can now go and cross check this point. So already told you, this point is going to be connected with the income from means deduction chapter. Now it's very easy to link this. Okay, go and see that particular one, income from other sources. And if you borrow for constructing residential house property, okay, residential house property, clear. Repayment of loan can be deductible under section 80C. See, X borrowed, say, 50 lakhs for construction of the house property. For the previous year, 24-25, okay, he has to repay that, right? He repays around 50,000 rupees. Sorry, 5 lakhs rupees. Apart from that, he pays the interest around 5 lakhs rupees. This is interest, this is loan repayment. So year on year, he has to repay the principal amount a part and also interest for the balance amount he has, right? EMI includes what? Small interest component as well as a small portion of the uh, principal amount. This interest can be deductible under what section? Section 24. Income from house property, you have studied that under section 24, class A and B. So standard deduction 30% and interest on loan borrowed for the construction of house property can be deductible. Also we studied. Interest can be deductible under section 24, or we will study that along with 80EE subsequently. You can claim there also 80EE, 80EA and all. This principal repayment can be claimable as deduction under section 80C. Is that clear? Don't get confused. Interest is not deductible under section 80C. Only the principal repayment is deductible under this section. So repayment of loan, it's not repayment or interest payable for the loan. Okay. But provided the loan should be taken from central or state government or any other bank, LIC, National Housing Bank, or from the employer, where the employer should be a statutory corporation, public company, or university, college, or local authority, cooperative society. So it means you have to borrow from the recognized sector, recognized banks or recognized sector or government. Only you can claim the deductions. And if the property is sold within 5 years, then the deductions claim will be reversible. You should keep that property for a long period. If it is not so, then you have to reverse this. You have to reverse this. Hope you will be now able to understand L and R. Okay, among so many items, right? Units, LR and PM. The most important detailed discussion required being these two, L and R. The rest are just like you can finish off. Now P, public provident fund, recognized provident fund, statutory provident fund. Not being repayment of loan can be claimed as deductions for self, spouse and children. The provident fund can be in the name of self or spouse or children. In case of HUF, any member, okay. C, employee, employer and PF. As he works here, he can deposit his contribution to the PF department. An employer also collects and deposits. This can be deductible. But sometimes later, if the employee is in need of getting the loan, he can simply get the loan here. Simply get the loan from PF department. Is an emergency. There's an investment in PF. No, can be withdrawal only at the time of resignation or in the case of emergency. So now he gets a loan, sir. I need personal loan for my hospital expenses or some emergency expenses. Give me. Thereafter, he repays this loan repayment along with the interest. What is deductible under section 80C? Only the original contribution, not this one. Not this one. It should not be in the form of repayment of borrowed loan. Loan borrowed, pledging the PF balance and repaying along with the interest, not eligible for deductions claiming. Okay. So PF not being repayment of loan can be deductible. Another P being superannuation fund also being considered as this one. And for spouse and children can also be invested, but maximum 1/5 of the salary can be invested. And even annuity plan with LIC also can invest Jeevan Dara, Jeevan Akshay, New Jeevan Dara, etc. Or any other insurer, you can invest that. So P. Finally, M represents mutual fund or UTI's investment. Hope you will be now able to understand all these cases. So I already told you, all the list where you need to be careful with LIC as well as repayment of housing loan. These two are very, very important. Clear? Shall we go for solving the illustrations covering ADC deductions? So units LR PM is over now. Now, compute the eligible deductions under section 80C for the assessment year 25-26 in respect of life insurance premium paid by Mr. Ganesh. So, pension insured, person insured being self-allowed, spouse allowed, handicapped son, section 80U disability, 80U, 80DD, both are same, like, okay. Okay. In case of handicapped son, 3 dates are there. Okay. What are the dates are there? 31/3/2012 before and 31/3/2013 between this and after this. 20% of sum assured allowed, 10% allowed, and 15% allowed. This is for 80U category or 80DD category. Others, here 20%, thereafter 10%. Very simple. It means the policy taken in which date. In the first case, the policy taken which date? Before 31st March, then 20% is allowable. 20% will be allowable. Deduction on sum assured, 20%, maximum deduction. And spouse purchased on this date, so falls under this category. So only 10%. Disability also falls in this case. 15% is allowed. 15%. So 20% on this 1,20,000 or 51,000 premium paid, whichever is lower of X percentage of sum assured and 2 premium. This is that X percentage, right? Assumed. 20% on this being 1,20,000 or premium 51, whichever is lower, 51 can be deductible. 1,50,000 into 10%, 15,000 or premium paid 20, whichever is lower, 15,000 is deductible. 15% of 4,60,000 rupees or 80,000, whichever is lower, 60,000 is deductible. Now, overall deduction in this case being, add up the three. 1,26,000 is the deduction claimable under section 80C. The maximum limit being 1,50,000. So, entire 126 can be deductible. Now, an individual assessee resident in India has made the following deposits. Contribution to public provident fund, of course, deductible. Insurance premium paid on the life of spouse, policy taken on this date. So on this date mean only 10% is allowable. So 20 or 25,000, whichever is lower, 20,000 is allowable. 1,70,000. Any of the limit under section 80C being 1,50,000. So deduction under section 80C being only 1,50,000. Is that clear? Clear? The maximum ceiling deductible under section 80C is 1,50,000. Now, now, Mr. Srinivasan, aged 66 years, furnishes the following particulars for the year ending 31st March 25. Life insurance premium paid 40, actual capital sum of the policy being 1 lakh 50. So 10% being only 15,000 is taken. So as the policy is taken on 2022, 15 or 40, whichever is lower, so 15 is deductible. Contribution to PPF in the father's name, not allowable. Usually ATC, no, not eligible for the parents, not eligible for the parents. Tuition payment, fees payment 5,000 each for 3 cents. Pursuing full-time graduation course in Mumbai, so restricted to only 2 cents. Tuition fee paid for daughter pursuing PhD in Melbourne University, Australia. Should be in India, so this is not qualified. This is qualified, that too only 2 cents qualified. So 5,000 each means for 2 cents, 10,000 is deductible. Housing loan principal repayment of rupees 30,000 to HDFC Bank. This property is under construction at Bangalore. Still under construction, not completed. So as the property is in construction, you are not eligible for claiming the deductions. Otherwise, the principal repayment can be deductible subject to a maximum ceiling of 1 lakh 50. Right. Principal repayment of housing loan taken from a relative 60. The property self-occupied and situated in Chennai. Relatives is disqualified. Already told you, in case of housing loan, should be from the structured environment, structured banks and colleges, governments and all, right? So this is not qualified. Deposit under senior citizen savings schemes. So senior citizen, investing in senior citizen savings schemes is deductible. Okay, triple S like Suganya Samriddhi account, stamp duty value as well as senior citizen scheme, deductible. 5-year deposits, time deposits, term deposit with the post office, 20,000 rupees deductible. Okay, T. Tuition fees and time deposits. Investment in NSE. NSE is also deductible. So in N we have 4N. NSE certificate, NABARD, National Housing Bank as well as National Pension Scheme, Tier 2. Okay. So here bonds from NABARD, 80,000 rupees can be deductible. Get me the total, 1,65,000. Anyhow, the limit under section ATC being 1,50,000 only. So deductible under this section being 1,50,000. Clear? One second. Now, compute the quantum of deduction under section 80C for Mr. Neeraj. Life insurance premium own self, okay, capital sum assured 2 lakhs being the first premium, means just now they have invested, only 10% is allowable, or compare these two, whichever is lower, 20,000 is deductible. Brother's life not be qualified. Self, spouse and children may be dependent or independent, doesn't matter. Major son, yeah, of course allowable. Contribution to recognized provident fund, allowable. RPF. Repayment of bank loan for purchase of residential house property, allowable. Tuition fees for income part-time is disqualified. What's the overall value? 1 lakh. Ceiling is 1 lakh 50, entire 1 lakh is deductible. Entire 1 lakh is deductible. Next. Mr. N is employed at a gross salary of rupees 8 lakhs. He gets 15,000 interest on bank deposits. He has made the following investments and deposits. ULIP, yeah, of course, you can claim the deduction. Repayment of loan to SBI to purchase a residential house 1 lakh 20. Out of 1 lakh 20, 50% towards interest. Towards interest is disqualified only to the extent of principal repayment is qualified, which is 60. Infrastructure bonds deductible 90. Besides interest of 1632 on NSE 8 has been credited. Credited means you are not withdrawn. NSE you have purchased. In which year? 2021 you purchased NSE, National Savings Certificate. For that, in this current year 24-25, 1632 credited. Not withdrawable. It will be withdrawable only at the time of maturity. Any interest accrued on that NSE is also considered as not being withdrawn, but accrued in the NSE is considered as investment made. Now come on, get me the total value. 1,56,632. Limit in this case being 1,50,000. So deductible being 1,50,000. Here. In NSE, the main thing you have to understand is this one. Okay. National Savings Certificate and the interest accrued thereon, assumed, deemed to be reinvested. As per that logic here, the amount accrued and credited in the NSE account is considered as reinvestment, qualified for the deduction under section 86. Only because of this point, I have included this illustration. Yes, the illustration is very simple. Only this point, only for this point. Okay. Hope now you'll be able to understand. So with that, 80C is over. Now let's move on to the 80CCC. Under 80CCC, deductions for contribution of annuity plans, especially in LIC or other insurer, can be deductible under section 80CCC. The amount deductible under this will also be 1,50,000. 1,50,000. And here this income, this amount deposited should be income chargeable tax. Okay, it should be invested from the income chargeable tax. Earlier 80C, you know, either you can use the exempted income or taxable income for investing in these schemes. You can claim the deductions, but under 80CCC, you have to invest only out of your taxable income. Okay. In the hands of the nominee or the assessee, surrender before maturity shall be taxable. Pension received later on year after year will also be taxable on receipt basis. Okay. So once you claim the deduction under section 80CCC, you cannot claim the deduction under section 80C. So 80CCC scheme is available only for the individuals. It's an annuity plan like pension. Maximum deduction is 1,50,000 and the amount deposited should be out of chargeable taxable income. And on withdrawal, before the maturity, if you withdraw, fully taxable, or if you are getting it as a pension year after year, also be taxable in the year of receipts. That's all. Okay. Now we'll move on to the next section, 80CCD. 80CCD is one of the most important sections. Already we covered this along with section 36, and we covered a slight point in pension, also in salaries. In all the cases that NPS, I will guide you later on along with the deduction. That's how I might have stated earlier classes. So now we are going to discuss that 80CCD in detail. National Pension Scheme, or Tier 1. Tier 1. Okay. Tier 2 falls under 80C, here Tier 1. This 80CCD, CCD is nothing but contributions to National Pension Scheme or Atal Pension Yojana scheme. Applicable only for the individuals. Applicable only for individuals. Okay. Now, a list is given here. Very, very important here. So, three sections you have to understand. What are they? 80 CCD class 1, 1B and 2. These are the three sections you have to understand. These are the three sections you have to understand. I'll first explain all these things in detail here. Thereafter, you'll remember this picture, this table for your better understanding. Right. Now, under 80 CCD class 1B, 80 CCD class 1B. Okay. So, this NPS is similar to what? PF, like employees and employers contribution both will be there, right? Employer also contributes, employee is also contributing. Finish up the PF logics and NPS logic and all before you study this one. Otherwise, I'll just give a small briefing here. Okay. Employee, employer and employee. Okay, employer and employee. Employee rendered service. For that, employer makes the payment by way of salary. Say 12 lakhs per annum. 12 lakhs per annum. Employer deposits around 10% of the salary as his contribution, 1.2 lakhs. Apart from that, he deducts 1.2 lakhs from the employee's contribution and he deposits that one also with the NPS. 1.2 lakhs. 1.2 lakhs. Okay. This one being employee's contribution to NPS. We have already studied that under what? PGBP. For the employer, it falls under PGBP in P&L account. The amount paid on behalf of the employee in NPS account can be debited in the P&L account. That's how we studied. Employer's contribution can be debited to the P&L account. Employee's contribution received and deposited. Received and deposited within the due date, no problem, you can claim the deductions. That's how we studied already. Okay. In case of the salaries chapter, this is all about the PGP chapter. In case of salaries chapter, whatever the amount deposited by the employee, means employer in his account, will be exempted to some extent. Now, I'm going to guide under section 80 CCD deductions angle. Here, I'll start with 1B class first of all. Under 1B class, employee's contribution or a ceiling 50, whichever is lower is deductible. Employee's contribution being 1,20,000, ceiling being 50, whichever is lower is deductible under section 1B. And then go for section 1. As per section 1, okay. Now, here, employee's contribution, okay, whichever is lower of. Employee's contribution minus 1B deduction already claimed, that 50,000. Okay, balance amount. Actually 120, already 50 claimed, so it is 70,000 rupees. Second one being 10% of salary. Salary for this purpose being basic DA forming part of salary will be taken. Here 12 lakhs, 10% of that being 1 lakh 20. Between these two, whichever is lower, 70,000 can be deductible. Can be deductible. Section 1B as well as 1. Then what about the 2? 2 is nothing but employer's contribution. 2 is nothing but employer's contribution. 80 CCD class 2. This is nothing but employer's contribution. First of all, the amount received will be part of income. These two will be first of all added as salary. What is the salary of the employee? Basic 12 lakhs. NPS contribution by employee as well as employer. Employee being 1.2 lakhs, employer also 1.2 lakhs. So 14.4 lakhs is the gross salary or gross total income. From that, you have to deduct all these things. So employer's contribution first included in our salary. Thereafter, you can claim the deductions. Okay, this is the actual one. Here. Okay. Employer's contribution, whichever is lower of employer's contribution or 10% of salary. 10% of salary. Employer's contribution being 1.2 lakhs. 10% of contribution also being 1 lakh 20. Whichever is lower, 1 lakh 20 can be deductible. What is the total value? 2 lakhs 40. This 2 lakhs 40 can be deductible from here. Balance is total income. 12 lakhs is the total income for the taxable purpose. Before the deduction under section 80 series, so you know the total income is called as gross total income. From that, deduction under section 80 series is subtracted to get the total income. Total income. You are going to calculate the tax on the total income. On the total income only, not the gross total income. Remember, this 10% is equivalent to 14% in case if it is being the central government. In case of central government or state government employees, then automatically what happens, this limit rather than 10, it is 14%. Okay. So whatever the NPS contribution made by the employer as well as employee, not employee, employer's contribution. Sorry, not this one. This is 12 point, I made a mistake. This 12 lakhs is already inclusive of this amount, right? So both will be included here. 10.8 and this one. So this is 12 and employer's contribution. So then this value being, come on, 13.2 lakhs, and if I subtract this, then the ultimate value being how much? 10.8 lakhs. Is taxable. Clear? So rather than 10, it may be 14% of the amount being from government, central government or state government. Now, in case if he is not being the employer or there is no employer-employee relationship, he voluntarily invests his own, like PPF. RPF is contributed by employee as well as employer. If I am being the self-employed, do I want to enjoy this facilities, means can I do so? Yeah, of course you can do so. So their employer and employee both contribution can be contributed by yourself. Similarly, here also, if you are not being the employee, you want to deposit for yourself, then you can enjoy the 2 times of the benefit. Rather than 10, you can enjoy 20 times benefit. So this will not be existing, only this will be existing. Rather than 10, it is 20%. Clear? This is for self-employed people. This is for self-employed people. Now, self-employed or salaried, for it may be section 80 CCD class 1B is same. Assesses actual contribution or ceiling 50, whichever is lower is deductible first. If he is being salaried, I will move from here to here. Now I will start with 80 CCD class 1, where whichever is lower of employee's contribution less deduction already claimed here. This is the first number. Next one is limit 10%. Whichever is lower is deductible. Then 80 CCD class 2 is all about employer's contribution here. Whichever is lower of employer's contribution, 10% of salary. between these two, whichever is lower. Okay. In case of default tax regime, it's 14%, 4 it may be. Okay. In case of old tax regime, okay, central government, state government, then it is 14%. In case of default tax regime, whether central government or state government or other than central or state government, 14% will be available. In case of old tax regime, only for the central and state government, 14% is available. Is that clear? So, new tax regime, old tax regime. Central government or state government, then 14%, 14%. Others, 14% here only 10%. Is that clear? Under old tax regime, we have two numbers, 14 and 10. Under new tax regime, 14, 14. So under new tax regime, only 3 deductions can be claimable. Already told you, no deductions are eligible. 80 series deductions not available. Only 3 deductions. Among them, the first one being this one. 80 CCD class 2 deduction is available for the new tax regime as well as old tax regime. Okay. Available, all the deductions available if the assessee opts out of the default tax regime. Okay. Except 80 CCD class 2, employer's contribution to pension scheme of the central government. Whose contribution? Employer's contribution. Number 2 being 80 CCH class 2, we'll see that later on. Agniveer Corpus Fund. Okay, these two. Last one being 80 JJAA. Only these 3 deductions are available if you are even applying the default tax regime, new tax regime, yet you can enjoy. So here 80 CCD class 2 is over. Clear? If he is being not salaried, self-employed, then the same condition, the 10 is replaced with the 20, but as he is being the self-employed, there is no salary, gross total income will be taken. In that gross total income, 20% can be taken. 20% can be taken. Is that clear? Okay. Let's now try to solve the illustration here. The basic salary of Mr. A is 1 lakh per month. Then what is the basic salary? 12 lakhs per annum. He is entitled to dearness allowance, which is 40% of the basic salary. So DA being 40%, 4 lakhs 80. 50% dearness allowance forms part of the pay for retirement benefits. So basic DA forming part of salary. 12 lakhs, and in this 4 lakhs 80,000, only 50%, 2.4 lakhs will be taken. 14.4 lakhs will be the value here. Both Mr. A and his employer ABC Limited contributes 15% of the basic salary to pension scheme referred to in section 80 CCD. So you have to add the employer's contribution first of all, not employee's contribution. That employee's contribution is subtracted from the 12 lakhs, right? 15% of the basic is 12 lakhs, and for that 15% being how much? Come on, 1 lakh 80. Now we'll be getting salary, gross salary 18 lakhs 60,000 rupees. Okay, if you have the old tax regime, then you can claim the standard deduction under section 16. Okay, standard deduction under section 16 being 50,000 and 18 lakhs 10,000 rupees. We assume that he has no other income, so this becomes gross total income. Gross total income. And from that you have to subtract 80 CC D class 1B. 80 CCD class 1B, whichever is lower of employees contribution or ceiling 50. What is the employees contribution? 15% on the basic, which is 1,80,000. So between these two, whichever is lower, 1,30,000 will be taken. 1,30,000 will be taken. Sorry, 50,000. 50,000 will be taken. Then 80 CCD class 1. As per section 80 CCD class 1, whichever is lower of what? Number 1. Employees contribution minus deductions already claimed under section 80 CCD 1B. Employees contribution being 180, already he claimed 50,000, so it is 1,30,000. Second being 10% of salary. Salary for this purpose being 1,44,000. So 14,40,000 rupees. On that 10% being 1,44,000. Between these two, whichever is lower, 1,30,000 can be deductible. Then 80 CCD class 2. Employees contribution. Also, whichever is lower of actual employees contribution being 15% on salary 1,80,000, but 10% of salary will be ceiling. Salary for this purpose being basic plus DA forming part of salary 14.4 lakhs, on that 10% being 1,44,000. Between these two, whichever is lower being 1,44,000 can be deductible. Now what is the final value? 14,86,000 is the taxable value, otherwise total income. Hope now you'll be able to understand the difference between gross total income and total income. And the new tax regime, default tax regime, 18,60,000. This is not eligible. This is 75,000. Yes. What's the value? 17,85,000. 80 CCD 1B 1 not eligible, but 80 CCD class 2 is eligible. But how much is eligible? 14% eligible. 14% and 1,44,000. 2,06,000 or 180. Between these two, whichever is lower, 1,80,000 can be taken. Now what is the total income here? 16,05,000. Clear? Now, we'll move on to the next illustration. X is employed since 2017 by SCA Limited. His particular are as follows. A comprehensive illustration. Basic salary 40,000 per month for 12 months, 4,80,000. Dearness allowance 20 into 12 months, 2,40,000. But farming part being 1,20,000 only. This will be applicable for most of our further study. Employer's contribution towards NPS. Employer's contribution towards NPS 6,000 per month, then 72,000. Employees contribution towards NPS, no need to add, which is already a forming part of this one, so you have to subtract only. And these two are again deductions only. 3, 4, 5, 6 all are deductions. Now come on, find out the total value. Gross salary 7,92,000 minus standard deduction 16,000. Sorry, 50,000. 7,42,000 net salary minus 80C, 80CCC deductions. Okay, TPF. Limit is there. What is the limit? You can subtract 1,50,000 within the limit we have, so 70,000 can be deductible. And 80CCC, like some pension fund with the LIC annuity plan, 10,000 can be deductible. Limit is 1,50,000 for this. Now you have to start with 80CCD class 1B NPS deduction. 80CCD class 1B, whichever is lower of employees contribution, how much? 7,000, right? Into 12 months, 84,000, and limit 50,000. 50,000 can be deductible here. Then 80CCD class 1 NPS. So 80CCD class 1, you know, there whichever is lower of, okay, employees contribution minus 80CCD class 1B deductions already enjoyed. 84 minus 50, 34,000, and 10% of salary. Salary for this purpose being this one 6 lakhs. On that 10% being 60. Between these two, whichever is lower, 34,000. Now, see one more point I am going to guide you here. 80C, 80CCC, 80CCD, 1B and 1. All the value put together, how much is there? 1,64,000. Am I right? 80CCE, one more section we have. As per that section, all the 4 items put together, limit is 1,50,000. Is that okay? Very interesting. Clear? 80C, 80CCC, 80CCD, class 1, 1B as well as 1. All the item put together. Okay. No, leaving this one. 1B, you can leave this 1B and 1 only. Okay. I can make a slight correction here. 1. So leaving that, what is the value you have? Leaving this one, 1,14,000. Between these two, whichever is lower, 1,14,000 can be deductible. This 50, okay. 80CCD 1B is separate. 80C, 80CCC, 80CCD class 1, all the three put together should not go beyond 1,50,000 as per section 80CCE. 4 items we have seen: 80C, 80CCC, 80CCD class 1B, 80CCD class 1. Among the 4, 1 is left, 80CCD class 1B. Remaining 3 should not be more than 1,50,000 as per the provisions under section 80CCE. Now, then we'll go for what? 80CCD class 2. This is also employer's contribution of NPS. In case of employer's contribution of NPS, first to take the employer's contribution. How much is that? 6,000 per month for 12 months, 72,000. And 10% of salary will be taken, which is 60,000. Between these two, whichever is lower, 60 will be taken. From the gross total income, 7,42,000. You can subtract the 3 deductions, so the ultimate value being 5,18,000. 5,18,000. Here is 80CCE. Aggregate deductions of 80C, 80CCC, 80CCD class 1, all the 3 put together, restricted to 1,50,000 only, not beyond that. Restricted to 1,50,000, not beyond this. Is that clear? Hope you will be now able to understand this one. Clear? So then we'll go for the contribution to Agnipath scheme. With that, we'll conclude today's lecture. So I'm covering almost all the C series: 80C, 80CCC. 80CCC is all about annuity plan with the LIC. You have to put more attention only with respect to 80CCD series. In 80CCD series, we have 3 subdivisions. One is 80CCD class 1B, where employees' contribution to the extent of 50 is deductible without any limit. Then 80CCD class 1, also employees' contribution in excess of the deduction already claimed can be deductible here. But the 3 sections, 80C, 80CCC, 80CCD class 1, all the 3 put together should not go beyond 1,50,000. 80C maximum 150, 80CCC maximum 150, 80C, 80CCC, 80CCD class 1, all the 3 put together 1,50,000 as per 80CCE. Okay, clear? Sir, why sir? There is a limit under 80CCE directly. Why do we have 150 for 80C, 150 for 80CCC and all? Earlier, only 50 is internal exemption given under 80C. Another 50 like 1,50,000 or 75,000 for 80CCC. Like thereafter, they increase the limit for 80C to 150. The ultimate limit under 80CCE remains the same 150. That's a problem now. We have 1,50,000 only. All the 3 items put together. Clear? Let me summarize here. 80C deduction, units, LR, PM, 4N, 2T, 3S, LR, 3PM, 3P and M. We have studied all these 6. And 80CCC, some annuity plan with LIC. And we have 80CCD class 1, which is NPS, employees contribution in excess of 80CCD class 1B deductions. this amount maximum 150, this amount maximum 150, this amount maximum 10% of salary. If you add up all these things, as per section 80 CCE, the limit in this case being 1,50,000. This 80 cc D class 1B you can enjoy at the maximum of 50,000 separately. This is outside the limit. So you can enjoy 1,50,000 separately, another 50,000 separately under section 80 cc D class 1B. What about the deduction to section 80 cc D class 2, sir? This is employer's contribution, sir. You can enjoy this benefit. This is outside the scope, can be enjoyable under old tax regime as well as new tax regime. In both the tax regime, you can enjoy this. So this is what about the summary we have discussed up to now. This is C, contribution series is set. We have completed completely. And here let's see. Gross total income of Mr. X being 8 lakhs. Gross total income. Right. Now, contribution to PPF 80 C 1,10,000. Payment of tuition fee to Abhijay School, New Delhi, education of his son studying class 11. Tuition fee 45. Repayment of housing loan taken from Standard Chartered Bank. Repayment of housing loan 25,000. Contribution to approved pension fund under LIC scheme 80CCC. Pension scheme for with LIC 1,05,000. This one is limited to 1,50,000. And this one is also limited to 1,50,000. So this 150, 80CCC 1,05,000 and restricted to 1,50,000. So 1,05,000 will be taken. 80C, 80CCC, 80CCD class 1 not given. All the two put together 2,55,000. Now, as per section 80 CCE, the limit being what? The limit being only 1,50,000. So then from this, it is very clear 1,50,000 can be deductible from this 8 lakhs. 80C, internal limit 150, 80CCC, internal limit 150, 80CCD, class 1, limited to only 10% of the salary. After these limits, you add all the 3 deductions, and all the 3 deductions values should not be more than 1,50,000 as per 80CCE. Okay. Now, in case NPS, you know, National Pension Scheme or Atal Pension Yojana scheme, if you close the account after the retirement, halfway through, if you are withdrawing, 60% will be exempted, balance 40% is taxable. After the death, if it is received by the nominee or legal heir, fully exempted on closure. If you are partially withdrawing, okay, for employee and self-employed, for the employee, withdrawal up to 25% of the employee's contribution. My contribution is there. If I am withdrawing from my contribution, 25% is exempted. If it is a withdrawal beyond 25%, then it is taxable. Not the employer's contribution. Only employee's contribution is withdrawn. In case of self-employed case, if he is withdrawing partially, then fully taxable. But from the NPS, if you are transferring later on to some other account, or RPF to superannuation fund to NPS, if you are transferring, then it's not taxable. Clear? These are the additional point you have to understand along with the NPS scheme. Then finally we have to discuss 80cch. Agni Path Scheme, Agniveer, also similar to what? PF, recognized or statutory PF like. Okay, this will be applicable for the Agniveer. Okay, a scheme framed by Agnipath scheme by the central government launched in 2022. Indian youth in the Indian armed forces, military men like they are getting the employment only for 5 years. Thereafter, they will come out from there and they will post at some other places. During the 5 years period, they will get a consolidated pay from the government, and after the retirement, you may say that you are having the ex-servicemen cadre also. It's one of the nice scheme. Immediately after +2 or under graduation, you can go and join Agnipath scheme, Agniveer like a soldier like. Okay, immediately +2. So during the 5 years training period there, okay, you can qualify yourself some degrees under correspondence. 5 years later, of course, you have the sufficient money in your account contributed by the government, and along with the qualification, you can come and serve in your practical life. That's how this concept is introduced. It's a fantastic concept. Applicable for the individual assessee condition, such individual is enrolled in the Agnipath scheme and subscribed to the Agniveer Corpus Fund, where Agniveer contributes 30% of his monthly package. Usually it is around 25,000 rupees salary, like 30%, 7,500 rupees he can invest here. And if you are investing 7,500, and the employer also, means government also invests the same. During the previous year, he and the central government has contributed a matching amount to his account in the said fund. He also contributes and the central government also contributes. The own contribution to the corpus under default tax regime, deduction not available, and the contribution by the central government, amount contributed will be considered for the deductions. 80cch deductions can be claimable. So from the gross total income, 80cch, for example, employee Agniveer contributes 7,500, employer means central government contributes 7,500. Under 80cch contribution, no, under new tax regime, the deductions will be allowable only for employer's contribution. Under old tax regime, you can claim the entire deductions under section 80cch. Okay, so default tax regime, only central government's contribution is deductible. Under optional tax regime, own as well as central government both can be deductible. Other points, contribution by the central government is included in the salary first, similar to the NPS scheme. We have to follow here also. The rest will be similar to other schemes. 80cch. So I have completed 80C, 80CCC, then 80CCD. In 80CCD, we have covered 1, 1B, and 2, all the 3, and then 80CCE, and finally 80CCH. So 5 sections completed. With that, contribution is over. The next class will start with the D series. Okay, see you in the next class.